The European Central Bank says it's weak demand inside China, not the US tariffs, that's driving Chinese companies to dump surplus goods in Europe. How much truth is in that statement to the agreement?
So there is a lot of truth to it, but it's not the whole story. The reason behind is that the ECB's own analysis finds export growth concentrated in sectors where domestic demand is weak, notably after China's housing downturn. So excess capacity and weaker home consumption have pushed the firms to seek foreign buyers by cutting price or accepting thinner margins. So that timing predates some of the recent US tariff measure. So the supply side or the domestic demand explanation is empirically important. However, tariffs and geopolitical diversion matters too. So US tariffs and a harder US stance can accelerate rerouting of exports to other markets, including the EU, and make exporters keener to regain volumes abroad. In practice, both force operates and the structural domestic weaknesses created the excess that make price competition possible. So the trade tensions have since reshaped the destination patterns.
Mm-hmm. Well, this Chinese domestic slowdown, how serious is it? Why is it pushing the Chinese manufacturers to sell more aggressively overseas rather than domestically?
So from my viewpoint, so I think the slowdown is materially significant and sector specific, especially where housing, investment, and consumption have cooled, and that weak home demand pushes firms outward. So the evidence shows that the recent statistics and commentary show the cooling retail and investment, and the housing sector has been a persistent drag since 2021 to 2022. So when internal demand is weak, firms with large fixed costs, such for example like steel, autos, and some manufacturing industries, either cut prices and export more or idle the capacity. So that is exactly what the ECB flagged as creating export supply pressure. So the mechanics is like firms facing falling domestic orders cannot quickly shrink capacity. So they preserve cash flow and market share by lowering prices abroad. So offering longer credit or accepting lower profit, which looks like dumping to importing producer.
Yes.
Yeah.
Well, in turn, some European industries say they're being undercut by cheap Chinese imports. Do you think Europe is heading towards a new trade clash, maybe with China?
So I think that the tensions are arising and the risk of an escalatory trade clash is real. But the outcomes really depends on the EU policy choices and the political appetite for confrontation. So there are some signs we can see that it's like the EU has opened multiple anti-dumping or anti-subsidy probes and imposed duties in recent months, such as tariffs, sweeteners, or some previous EV measures. And industries from steel to chemicals are publicly calling for protection. Reuters and EU trade announcements record a busy slate of investigations and duties. So, however, the EU also balance economic exposure. So, the big member economies such as Germany depend on China for demand and supply chains and prefer calibrated remedies rather than blanket tariffs. So we are likely to see targeted investigations and selective duties rather than an all-out tariff war, unless the political pressures force blunt measures.
Well, it seems that every now and then we keep talking about the de-dollarization, and quite recently we've been speaking about Russia and China choosing the yuan as the trade currency. Now, China is pushing to make the yuan a global funding currency. How does this challenge the dominance of the US dollar?
So from my viewpoint, the Beijing wants more external demand for the RMB yuan to reduce reliance on dollar financing. The lower currency mismatch risks for Chinese borrowers abroad and increase geopolitical and also the financial leverage but displacing the dollar remain a very long game. So the objective is like the internationalization reduce exchange rate risk for the Chinese firms and also the borrowers, helps China to export the financial service, and gives Beijing more clout in shaping standards and cross-border finance. The recent PBOC moves explicitly encourage offshore yuan financing and cross-border bond issuance to build liquidity and acceptance offshore. So the limits, whereas the US dollars is like the dollar's dominance rests on deep liquid markets and also the safe asset status, the legal predictability, and also the network effects. So the yuan face capital controls, shallower markets, and also the political risk concerns. So the conversion is incremental within the bilateral trade invoicing, bonds, and swap lines rather than an immediate structural replacement of the dollar.
Well, then, with a very attractive yuan with very low interest rates, do you think the world is entering a new phase of trade and currency competition between China, the US, and Europe as well? Do you think it is coming sooner rather than later at a much faster pace?
So I think yes, to an extent. So the cheaper yuan funding can raise China's financial footprint, especially among emerging market borrowers, but it's not a wholesale substitute for dollar financing. So the mechanism is like the lower domestic interest rates and targeted PBOC encouragements make RMB bonds and loans attractive to some sovereigns and corporates, lowering their funding costs and increasing onshore renminbi usage. We have already seen rising yuan bond issuance outside China in 2025 that creates channels of influence, and the lenders and borrowers become more interconnected with Chinese institutions and potentially more sensitive to Chinese policy shifts. So the influence is quite conditional, and the creditors prefer transparency, deep secondary markets, and legal protections. If renminbi assets are less liquid or carry policy risks, uptake will plateau. So expect growing influence in pockets such as regional borrowers, commodity-linked deals, and the bell roll participants rather than instant global dominance.